Welcome to the Deep Dive podcast, where we refuse to just skim the headlines. In the world of enterprise software, the stakes are too high for fluff. You need to know what's really going on beneath the surface.
Whether you're looking at a complex software implementation, improving your accounting controls, or a new security protocol, you need to understand how things really work when the rubber meets the road. I'm Ryan Caldwell. I'm here to help break down those complex ideas and systems so they actually make sense for your day-to-day.
And I'm Morgan Hale. I'm here to keep us focused on the big picture and ensure we get straight to the actionable insights you need to lead. Together, we'll talk with you like the advisors you'd hire to overhaul your tech stack.
We call this the deep dive. We are exploring the tools that power your business, from accounting and real estate to high-stakes security.
So if you're a CEO, a franchise director, CFO, or CTO, and you're looking for thorough analysis, you've found your home.
Let's get into it.
Let's dive in. Welcome back to the Deep Dive. We are doing something a little different today. Usually we're looking at the big picture, market trends, high-level strategy.
Right, the 10,000-foot view.
Exactly. But today we're zooming all the way in. We are looking at the plumbing.
And the plumbing is, well, it's usually where the leaks happen.
Oh.
And in corporate finance, those leaks get very expensive, very fast.
That's it, exactly. We've got a set of training documents here from Account Tech for their Darwin Cloud platform. But really, what we're talking about is a universal headache in accounting.
Intercompany billing?
Intercompany billing. It sounds so dry.
Oh, it sounds incredibly dry, I know.
Yeah.
But if you're a CFO, a controller, anyone who has to manage the books for a parent company that owns a bunch of smaller ones, this is the stuff that just ruins your month-end close. It's the sand in the gear.
It's that tangled web, right? Company A buys something that Company B really needed, and suddenly you're drowning in spreadsheets trying to figure out who owes what to whom.
It's like that dinner with 10 friends where one person pays.
Oh, I hate that.
Everyone hates that. You spend the next week sending texts about who had the extra glass of wine. But in business, if you get that math wrong, your entire balance sheet could be, well, basically fiction.
So our mission for this deep dive is to get into these Account Tech source docs, specifically the Advanced Intercompany Invoices training, and figure out how to solve this.
Yeah, how to move from that manual do from nightmare to what they're promising is a much cleaner automated workflow.
A single checkbox, I think, is the promise.
It is. From what I'm seeing here, it really boils down to that. So let's start with the why. Why build this complex web in the first place? Why not just have every subsidiary fend for itself? If I run the trucking fleet, why shouldn't I just buy my own tires and gas?
The source points to one very specific, very powerful motivation: the logic of bulk.
The Costco principle.
Exactly. But on a billion-dollar scale, if you're a holding company and you have 10 different subsidiaries and they all need laptops or raw steel or healthcare plans, it makes absolutely zero financial sense to let them negotiate 10 different contracts. You want to leverage the power of the purse.
You want to walk into the supplier's office and say, I'm not buying 10 laptops, I'm buying 10,000. Give me a deal.
Precisely. You centrally procure to get significantly better pricing and terms. That's the easy part. That's the smart business move. But, and the source is very clear on this, that decision creates an immediate logistical nightmare.
Because legally, these are strangers.
Right.
Even in the same parent company.
Right. We have to remember that even though they are all under the same umbrella, legally, these subsidiaries are often separate entities. They have their own P&L profit and loss statement, their own budgets, their own leadership.
So here's the conflict. The parent company, or one specific lead company, writes the check for the 10,000 laptops. The money leaves their bank account.
Correct.
But the laptops end up on desks in 10 different companies.
And that creates a massive distortion in the financial reality. If you don't have a system to fix it, the parent company looks like it's bleeding cash because it just spent millions on equipment it isn't using. Meanwhile, the subsidiaries look remarkably profitable because they just got a bunch of free equipment.
It's a lie in the books.
It is. It creates a false picture of performance. And that brings us to the mission of today's deep dive. So this isn't a new problem. Accounting departments have always dealt with this issue. And there's a term for the old way of doing this. It's called the pay-to, pay-from method. Even the name sounds awkward.
It was incredibly awkward and clunky. This is how accountants were taught to do it for decades, with manual journal entries.
So break that down. I'm Company A. I just paid a bill for Company B. What do I have to physically do in my books?
Okay, so first you open the ledger for Company A. You credit your cash account because money went out. Then you debit an asset account, usually called something like due from Company B.
Okay, step one.
But you're not done. Then you have to log out, open the books for Company B, and make the mirror entry. You debit their expense account, and you credit a liability called due to Company A.
So you're literally doing everything twice.
Double the work, and I'd say double the risk of an error. The docs call it very manual, very time-consuming, but the real killer was reconciliation at the end of the month.
Because if the numbers don't match...
If you type $500 in one book and accidentally type $50 in the other, your consolidated balance sheet is off. And you'd spend days hunting for that $450 typo.
Just soul-crushing work.
It's the definition of inefficiency. You're not adding value, you're just fixing mistakes.
Okay, so that's the pain we're trying to solve. Now, before we get to the Darwin Cloud solution, the source has this little vocabulary section, and I think we need to cover it because they use some really common words in very specific ways.
Oh, we have to, yeah.
Yeah.
The whole logic of the system rests on these definitions. If you mix them up, it all falls apart.
First one.
Customer. Right, so in this world, a customer is just the entity that owes you money. That's it. It could be a third party, or it could be your own subsidiary down the hall. If Company B owes you, Company B is your customer.
Simple enough. Supplier is the reverse, I assume.
Yep. The entity you owe money to. The vendor, Alpha Omega watches, or whatever.
Okay, now this is the one that always gets me. Invoice versus bill.
Yes.
In normal life, I use them interchangeably. Send me the bill, send me the invoice.
Can't do that here. The distinction is critical. An invoice is outbound. It's what you send out to get paid. A bill is inbound. It's what you receive that you have to pay.
Bill is in, invoice is out. And last one, pass-through expense.
The goal of this whole exercise. An expense that should, in theory, cost you zero. Money goes out, the exact same amount of money comes back in. But if the process breaks, that pass-through becomes a permanent hole in your pocket.
Okay, let's get into the mechanics, the how-to. This isn't plug and play, right? The docs show a whole setup phase.
Not at all. You have to configure the system first. You have to essentially tell Darwin, hey, we're going to be doing this intercompany stuff.
So step one is in the global settings.
Yeah.
Okay, I want to start with the thing that I found most confusing, or kind of counterintuitive in the training. This whole thing about setting up person records. Setting up a person. We're billing a company. Why are we creating a person?
This is a classic database design thing. It feels weird, but it makes sense. In Darwin, almost every entity is a profile of some kind. To bill your sister company, let's call them Demo Real Estate, you have to create a profile for them that the system treats like a person.
So it's an avatar for the company.
That's a great way to put it. It's an avatar. And here's the crucial step. When you create this new profile, under person type, you have to select prop management.
Property management. Why that specific one?
Because selecting that type is what makes the little intercompany checkbox appear on the profile screen. If you set them up as just a generic vendor, that option is hidden.
Okay. So it's a conditional field.
Exactly. You check prop management, then you check the intercompany box, and then you link that profile to the actual company and office in your database. You're building a bridge.
Got it. So, recap. Turn the main feature on, map the GL accounts, create the person avatar. Now we're finally ready to actually do a transaction.
We're ready to spend some money.
The source gives this fun example. Buying gift watches for agents from a supplier named Alpha Omega.
A classic agent retention bonus.
So the user goes into the bill screen, and they start entering the bill to Alpha Omega. It's for over $1,200 that's going to be paid by the parent company. Looking at the bill, the bookkeeper sees that some of the charge is for 2 of the offices at the parent company. So she can charge each one. That's just normal in-office expense allocation. But the rest of the bill needs to be charged to 2 of their subsidiaries. So she clicks the little checkbox which launches intercompany mode. The screen changes, and for the rest of the bill, she puts part of the bill to the 2 other companies that need to get charged. In the training material, I see that the screen doesn't just flag the charge to the subsidiary, it even sets which office, specifically in that office, should be charged for the bill.
Yeah, that's really powerful. And if you go to the end of the training material, there's even an option to charge parts of the bill to individual agents at the other company.
You know, I can think of a bunch of situations where that would be really useful.
So you finished entering the bill. Part of it is to two offices owned by the parent, and some of the charge to one of the subsidiaries, and some to another one of our companies. The whole bill is entered for the right amount. And now you can pay Alpha Omega.
Okay, this is fine. We've entered the bill, we've paid the bill, the system knows who's supposed to pay us back, but we haven't actually asked them for the money yet. The invoices don't exist.
Not yet. And in the old world, this is where you'd sigh, minimize the screen, open up accounts receivable, and start manually creating two separate invoices.
Which is where you'd make a typo.
Exactly. But here, on that same bill entry screen, there's a big green button.
Invoice now.
You click it, the system just gives you a little confirmation pop-up. This will invoice all the items on this voucher. You click yes.
And then?
And then it's done. Instantly. The source shows the little success message. Two invoices were created successfully.
Just like that.
Just like that. The system took the splits you defined on the bill and automatically generated the corresponding invoices in accounts receivable. It used the same description, the same amounts, the same GL codes.
It's creating the payable and the receivable at the exact same moment.
From the same source data. It creates a hard, unbreakable link between the money going out and the money you expect to come back in. It's almost impossible for them to be out of sync.
Okay, that's a huge improvement. But, trust but verify. I click the green button. How do I actually know it worked? Where do I go to see these new invoices?
The training docs walk right through that. You go over to the sales module, because an invoice is a sale, and you search for unpaid invoices.
And I can filter by the company I just billed.
You filter for testing real estate, which is the example company, and boom, there they are. Two new invoices sitting there ready to go.
Okay, let's flip it around. I'm the manager at Office 8. I was busy. I didn't even know this was happening. What do I see on my end?
This is what they call the mirror image. You don't get an invoice, you get a bill.
To me, it's a bill I have to pay.
Exactly. In your system, voucher, #1426 just appears. It says, gift watches for agents. The amount is $100. And, this is the beautiful part, it's already coded to your agent bonus expense account.
Because of the mapping we did way back at the start.
All that setup work pays off right here.
Yeah.
The data just flows. Nobody at Office 8 had to retype anything or guess which account to use. It just lands in the right place, ready for approval.
That gets at a really interesting point about just organizational friction.
What do you mean?
Well, think about how often one department avoids buying something for another because the paperwork is just such a pain.
Oh, absolutely. The cross-charge is a nightmare, so you don't do it. It creates silos. People hoard their own budgets because sharing is administratively too difficult.
But a workflow like this, it makes the borders between those internal companies almost disappear.
It makes them permeable. It lets the organization act like a single organism. The resources, the watches in this case, can flow to where they're needed most, and the accounting just follows along quietly in the background.
So to sum this all up, we went from that pay-to-pay-from manual mess
to a single streamlined workflow. We defined the why, the need to front cash and property management. We decoded the very specific vocabulary.
We did the one-time setup, flicking that switch in the settings, mapping the accounts, creating the company avatars.
And then the actual process. Enter a bill, check one box, split the costs, and hit Invoice Now.
And then verify. Watch the invoices just appear.
It's a system designed to make sure that pass-through expenses actually pass through. It protects your cash by making it harder to forget to bill someone than it is to actually do it.
The big takeaway for me is how much a simple software configuration can be a reflection of business strategy. If that little checkbox is available and you don't turn it on,
you are actively choosing to be inefficient. You are volunteering for manual data entry and reconciliation headaches.
And nobody should be volunteering for that.
Not in 2026. Absolutely not.
We'll leave it there. A really interesting look at how a small feature can have a huge impact. So, if you're listening and you manage multiple entities, maybe go poke around in your settings, see if that intercompany toggle is set to 2.
It might just save your month end.
Thanks for diving in with us. We'll see you on the next one.
Floating like a butterfly, new set afloat, sung like a lullaby. Brace yourself as the beat hits ya. Dip, trip, flip, fantasia. What's that? Diddy, diddy, bop. Yeah. to zone and vibe. Funk confusion, a fly illusion keeps you coasting on the rhythm you're cruising. Up, down, round and round, rhymes profound, but nevertheless you got to get down. Fantasy freak through the beat so unique, you move your feet and sweat from the heat.